They told you the markets were calm, but calm is the most dangerous lie in finance. Markets flinched when the extension hit the wires. Stocks didn't surge and commodities didn't spike. Traders read it as a shrug. Don't mistake silence for safety. If the truce breaks in November, tariffs snap back overnight, and that raises import costs across core categories. Inflation pressure returns when central banks are trying to ease, and that combination can rattle risk assets fast. Stay with me, because in a minute I'll show you the positioning framework pros use when a political pause can break either way. It keeps upside on the table if calm holds, and it limits damage if talks collapse. Before I reveal it, you need to see how this window behaves. This 90-day extension isn't a gift. It's a calculated stall that lets each side manage optics and lines while markets price in quiet. History explains the pattern. In past truces, price action often stayed stable during the middle of the pause and then jumped in the final weeks. Here's the risk path if the truce fails. Tariffs return at full force, and importers try to pass higher costs to consumers. That pushes a new round of price pressure through goods, squeezes margins, and can trigger retaliation that spreads across regions. Here's the other path. If negotiators extend calm into a longer agreement, the fear premium fades and flows lean back toward risk. Freight rates ease, order books stabilize, and volatility cools, but that transition still happens in stages. Both paths have consequences for portfolios. The key is that the rotation starts before the press conference, not after. Let me open the loop I promised. What's the positioning framework that keeps showing up in windows like this? It's a balanced stance that carries enough defense to handle a break and enough exposure to benefit from stability. What happens next will determine not this quarter, but how the next decade begins. Start with a durable core. Hold assets that generate steady income and don't depend on perfect conditions. Wrap the core with measured defense. Use exposure that tends to hold value when tariffs return, like producers tied to essential inputs or cash-rich defensives. Keep the size moderate so you aren't betting on failure. Prepare for it. Keep a small cushion of safe haven exposure while prices are still reasonable. Owning a little can be cheaper than scrambling for it later. Now add a selective slice of growth that benefits if calm holds. Look for real demand, strong balance sheets, and pricing power, because those traits perform even when the tape wobbles. Here's why this makes sense. The 90-day window compresses decisions and tempts people to wait for clarity. Professionals don't try to guess the headline. They build the posture slowly, they test it on calm sessions, and they listen to the tape more than the chatter. Consequences matter, so let's name them clearly. You can avoid both traps with a simple rule. Build and scale with confirmation instead of waiting for the final week. Think of the truce like a lid on a pot. The heat underneath didn't change. If the lid stays, pressure releases in a controlled way through lower volatility. If the lid pops, the steam escapes fast and whoever stands too close gets burned. Write down your maximum exposure for each sleeve so one headline can't knock you off plan. Calm sessions are your tells. If your core holds gains on a quiet day, if measured defense stops drifting lower, and if leadership expands without a catalyst, the flow is tilting in your favor. Now let's close the loop. The framework that works in this window is simple to describe and powerful to execute. Carry a durable core, wrap with measured defense, and keep selective growth ready to scale as calm endures. This isn't doomsday positioning. It's readiness positioning that takes advantage of both outcomes. If the truce breaks, you're cushioned and liquid. If it holds, you already own what benefits most. You'll see why patience right now is the most aggressive move you can make. One more mindset keeps you from second-guessing. You don't need to predict the exact day of the decision to win. You need the right posture while the odds evolve. Process beats prediction because process is repeatable. A quick look back helps. In past pauses, investors who built and scaled with proof avoided the worst drawdowns. Those who waited for certainty often bought protection on spikes and sold relief on dips. There's a rhythm to these windows. The first month feels calm, the second hums with positioning, and the last weeks carry the sharpest moves. Deadlines force decisions that chatter can't delay. Use that pattern to your advantage. The earlier stretch is for building the core and testing defense. The middle stretch is for adding selective growth as leadership holds, and the final stretch is for trimming excess risk if talks sour or leaning if progress becomes visible. We're not done yet because the most important shift hasn't happened. Put simple targets in your head. A modest core yield you can hold beats a higher yield you'll abandon. A small defensive sleeve that offsets some downside beats a perfect hedge you never buy. A starter position in calm winners teaches you how they behave. Watch behavior on quiet sessions because large players prefer to move when no one is looking. If a group lifts on low news days, that's not hype, that's allocation. If high beta sells off on nothing while havens grind up, that's not noise, that's caution. Remember that chains don't turn on a headline. Importers place orders months ahead and logistics adapt slowly. That lag means pricing effects from tariffs hit all at once, but sentiment often does, and prices move on sentiment long before invoices change. Think about second-order effects. If tariffs return and margins compress, companies may cut capex, delay hiring, or raise prices. Those decisions flow into guidance and into household budgets. Markets start discounting as soon as step one appears. Put the same logic on the positive side. If calm holds, order visibility improves, inventory planning normalizes, and credit spreads can settle. That's why the rotation begins before anyone writes the headline you're waiting for. Protect your attention. Pick a few signals that matter and ignore the rest. Focus on the curve, real yields, leadership on quiet hours, and how defensives behave. Let that small set drive decisions instead of the noise cycle. If you're still here, you're already ahead of the majority who will miss it. Set rules for when to add and when to cut. If calm leaders hold gains 3 sessions in a row, scale a notch. If havens on no news for 3 sessions, tighten risk. If both happen in waves, wait for a clear tell. It helps to write a short plan you can read in 30 seconds before you trade. State your core, your defense, your selective growth, your cash buffer, and the conditions that change each one. You'll make better choices when the plan is on paper and fear doesn't get to improvise. Don't overlook liquidity. Windows like this can shift from the fast without warning. Favor instruments you can exit so execution doesn't become the risk. Keep your ego out of the timeline. If a breakthrough arrives early, let winners run. If talks sour early, pull risk. Flexibility is how conviction survives new facts. Put simple checkpoints on your calendar so you don't drift. Mark the midpoint of the truce, the final month, and the final 10 days. Review your core, your defense, and your selective growth on each date and adjust with the tape, not with headlines. By the time this quiet ends, the smartest money will already be in position. One last reminder before we finish. This window rewards preparation and punishes hesitation. Build early, scale with proof, and keep enough cash to act when the crowd wakes up. Position during the pause, not after the break. That's how capital moves from the cautious to the prepared. If you want to stay ahead of shifts like this before the headlines, subscribe to Wealth Sitting now. This is where you get the playbook before the rest of the market even knows the game is on.